Good afternoon and welcome back everyone to the Moneycontrol live stream. You're watching another edition of Markets with Santo and CJ. Well, if you look at the session, it's been a largely positive day for investors after past 2 or 3 days of consolidation for the bulls, largely led, of course, by the global markets, the cues coming from global markets, as well as the outcome of the Gujarat general election. Now, if you look at the Nifty and the Sensex, we have seen moderate gains. Of course, it was flip-flopping between gains and losses throughout the session, but the past 1 hour we have seen the market pick up some bit of momentum, and right now we are firmly in the green territory. Also, if you look at the reason why the sentiment picked up a little bit is because BJP at this point of time, the incumbent party in Gujarat, seems like it will form, a fresh government in that state, probably with the largest margin of victory or largest number of seats since 1985. So clearly a big positive coming for the market on that front. Simultaneously, if you look at the global markets as well, European markets started off on a strong footing earlier this afternoon, and also the reopening of the Chinese economy continues to bolster global economic outlook at this point of time, even though there are still concerns about recession in the US as well as the Europe next year. Since, of course, if you notice that since the time we have crossed the peak that we had hit in October 2021, and now we are sitting in record high territories as far as the market is concerned, it seems that the market seemingly has lost a little bit of its direction. Now, how it will shape up, in 2023, to understand that, as well as to understand what to do with your portfolio going ahead into next year. Joining me today is Anand Shah, who is the head of PMS as well as alternative investments at ICICI Prudential AMC. Now, Anand, of course, is a veteran of the market and clearly no other person to better ask the sort of questions that I have at this point of time for him. Welcome to the show, Anand. Thank you so much for joining in.
Hi, good afternoon. Always a pleasure to be here. Thank you very much for calling me.
Thank you. Always a pleasure to have you as well. Anand, first up, of course, it's been a very solid year as far as 2022 is concerned for India. But, recently Goldman Sachs, said that it will probably be a little difficult for the Indian markets to continue this outperformance to their global peers in 2023. When you look at the setup for India and the Indian economy for 2023, how do you, comprehend it? Do you expect this outperformance to continue, or do you probably see Indian markets coming more in line with what is happening globally?
I think first let's talk about 2022, and I think India has done a phenomenal job in the sense that this was a difficult year for everybody. And we being part of a global economy, there's no way to say that we didn't had our own sets of challenges.
Yeah.
Particularly crude oil, where we are a net importer of energy basket, be it LNG, be it crude, be it coal. Indeed, it was a difficult year, and within that, I think we have done very well, and the rest of the world was struggling with different challenges, one being China lockdown, the other being high energy prices, third being rising interest rates and strengthening dollar. In the midst of all that, what we have done, I think it's excellent, and to that extent, yes, 23 will be a different story. I think for 23, the markets would need some bit of recovery, because India was relatively resilient, but it can't remain resilient if the global slowdown were to continue, or that it will suffer in US. And to that extent, I think we need more sort of a what would I say, some support from the global economy, which you already spoke about. We're getting some of that. The Chinese economy is opening up. That's a second largest economy, and can really boost demand for goods, raw materials, and to that extent can also help taming inflation, which in turn can reverse the tightening monetary policies globally. And to that extent, we can see some softening of interest rates towards the end of 23, some softening of dollar strength, which is also positive for emerging markets. So yes, we can't continue to outperform like this if the global challenges remain. But my take is that we will have a better global macro situation in 23 versus what we had in 2022.
Interesting, you say that, Anand, because if you look at the market setup at this point of time, especially for India, we are sitting at record high territory, of course, but also almost near peak valuations at more than 20 times 1 year forward earnings. And at the same time, if you look at the outlook for the global economy, it seems like 2023 is going to be a recession year with the US as well as the European market economies tipping into a recession. Whether that will be a hard recession or a shallow recession, we still have to wait and see that. Given that sort of a context, what sort of a strategy, an investment manager like you would be adopting? Would it be a buy on dip sort of a strategy, or would it be a sell on rise sort of strategy that you will be adopting next year?
No, first and foremost, we have a mandate to invest and we remain confident to stay invested in the Indian equity markets. But you spoke about valuations. And I think we need to go one step lower and analyze what part of the market is driving the expensiveness of the overall market. We've done a lot of analysis within the markets, and we believe there is a set of companies which are fairly expensive, and you would want to avoid that in the portfolio. At the same time, we have a set of companies which are well poised to do well from a growth, from the earnings, from the return on equities perspective, and they're not very expensive also in terms of valuations. And to that extent, our portfolios are more focused doing bottom-up stock research, identifying businesses which have improving fundamentals, improving, and the valuations are reasonable. So I think that's the way forward for 2023. Go bottom up, go granular, and stock picking rather than being a macro investor.
Understood. So basically, you're saying that it is going to be a more of a stock pickers market than a general theme-driven market that probably we have seen over the past 3 years.
Indeed, you're already seeing that in 2022 also. There are businesses which are emerging from a 5-year, 6-year challenging period. You've seen state-owned banks, you've seen state-owned companies, you saw metals did extremely well in 2021. First half of 2022, they've sort of struggled because of a Chinese close down, but the manufacturing continues to do well. Manufacturing had a very, very difficult decade way back. There are companies which are supporting manufacturing, like logistics, companies which are supporting capital goods and industrial products. They have done extremely well in 2022. So I think even the divergence has been significant even in 2020. There has been significant rewards for doing stock picking even in 2022. 2023 will be much more, is what my take was.
Understood. Interesting that you mentioned state-owned banks. Of course, if you look at state-owned banks the past week or 10 days, they seems to have been the toast of the town. Almost everybody at this point of time is, lapping up PSU banking stocks on the hope that there will be this, entire recovery in the capex cycle. We're already seeing very strong credit growth in the economy at this point of time. It seems to me, it reminds me of the sort of rally that we were seeing in IT companies last year, same time, when a lot of brokerages were quite bullish on this counter. Everybody at that point of time wanted to only buy IT companies, if nothing at all, So is there sort of maybe a case building to maybe go contrarian on the PSU banking space from a tactical point of view, not from a strategic point of view, but from a tactical point of view, given the sort of gains that we have already seen in banks like Bank of Baroda, Bank of India, you talk about Canara Bank, or you talk about State Bank of India?
Indeed, good you reminded me. I didn't speak about IT because, avoiding IT in 2022 was also an important investment decision that we took and one should have taken. But coming back to state-owned banks, I think you'll have to appreciate where they're coming from. And they're coming from since asset quality review that was started by RBI way back in 2015-16, led to significant recognition of NPAs. And 5 years, 6 years hence, we had a lot of significant recognition of stress in the banks, be it in manufacturing, be it in infra. So you had double digits in terms of total gross NPAs in some of the banks. You had significant write-offs that have happened in the last 5 to 6 years. So fast forward today, we are sitting on a fairly low gross NPAs. A lot of those NPAs have been written off and a significant provision done. And to that extent, the net NPAs is further lower. So I think Uh, Today, the banks are coming starting from a very low provisioning requirements per se. Now, the challenge for the banks would be how would the economy pan out in years to come? What happens to their borrowers? Would they again slip? Would there be more provisions to be made? Or would there be more recoveries? And that's where our view is a little different from the street. We believe, given that a significant prudence has been there in the incremental lending by the banking system in last few years since AQR, I think the incremental slippages would be lesser than what the street is expecting. More importantly, with manufacturing picking up, with need for infra picking up, we are seeing resolutions on many those past NPAs and past return of accounts, and to that extent, net credit cost into the banks should be lower as per our expectation. But nevertheless, that's only one part of the story. The other part of the story is as uh, credit growth picks up, because that was also another thing which was sort of fairly weak for a few years. The credit growth was low to that extent. Uh, your costs kept on going up, but your top line didn't go up, and that's what will change also going forward for at least a couple of years, when we'll have a very, very good, solid credit growth rate, corporate credit growth rate, leading to boosting of fee income also. So there are few reasons to believe that the things can continue to improve as they're already improving in last 2 years for the state-owned banks. And to that extent, again, it goes without saying that one has to do a lot of bottom-up research,
Yeah.
one has to identify, read balance sheets, and so there's no blanket advice here, but nevertheless, it's worth investing and prodding more within the state-owned banks.
Understood. So, thank you, Anand. Summarizing, basically, you were saying that the global macro environment could actually improve compared to, the sort of gloominess that we are seeing at this point of time. Secondly, that stock picking probably will remain the mantra. No blanket, buying or selling can happen in 2023. You have to go more stock specific and more bottom up, in your investment calls. And lastly, that there is still steam left as far as the PSU banking space is concerned. Have I summarized it well for you, Anand?
Indeed. Thank you very much.
Absolutely. Great. Thank you so much for joining in, Anand. Thank you so much. Lovely to have you and hope to, host you soon again on the show.
Pleasure. Thank you very much.
Great. Moving on, guys, of course, despite the sort of a bit, moderate gains that we have seen in the market, there are individual stocks that were doing quite well in trade. And out of those, two stocks really stood out for me today. First is from the metal space, and this is Hindustan Copper. Now, generally at the middle of this year when the copper, the metal rally sort of fizzled out and we had seen a lot of short positions being added into metal companies, Hindustan Copper being one of them, we saw a decent amount of drawdown in a lot of these counters. But over the past month or so, we are seeing a little bit of revival happening in the metal space, largely led by, what is happening at this point of time at the world's largest, commodity consumer, that is China. But if you look at Hindustan Copper, I think this is a story that probably is going a little underappreciated in the market. The reason I say that is because if you look at global and domestic demand for copper, I think that is likely to surge going ahead because of copper's essential requirement in the energy transition theme that that everybody around the world is talking about, more so in India at this point of time. The reason is that if you look at some of the alternative energy sources such as solar, wind, even electric vehicles, all of them require copper, and they require copper at much larger quantity than your traditional energy sources such as a gas power plant or a thermal power plant. So given the demand scenario and given the fact that underinvestment into copper mines over the past 5 to 10 years has resulted in sort of a supply squeeze at this point of time, it is very likely that copper prices could remain quite elevated over the next 4 to 5 years. That is the view coming out from generally most of the analysts out there globally. If you look at international copper prices the past 1 month, when there has been a talk of a recession in the US, in Europe, and some growth slowdown in parts of Asia, copper has actually rallied about 10%. So clearly, there is almost a secular bull market developing in the copper market at this juncture, and Hindustan Copper, being a large producer of the commodity and a supplier of the commodity in India, is most likely to benefit. So if we do see this sort of the sort of improvement that we are seeing in international copper prices translate into good earnings performance from Hindustan Copper, then you could possibly see a re-rating happening on Hindustan Copper in 2023 after what has been a largely resilient but not a great year for Hindustan Copper after the rally, the massive rally that we had seen on the counter in 2021. So that will be one stock to watch out for heading into 2023. The second stock would be Bank of India. Now, this is one stock I think it's really winning hearts of most analysts out there. Credit Suisse, after the street turning bullish on Bank of Baroda and State Bank of India over the course of the past 12 months, it seems it's now turning bullish on Bank of India. And Credit Suisse, a foreign brokerage firm, today came out with an upgrade on the counter, upgrading the stock to an overweight rating from an underweight rating. At this point of time, if you look at the commentary coming in from Credit Suisse, they believe that Bank of India's profitability is on course to improving quite sharply going ahead because you will have a very strong loan growth environment plus very lower credit costs for the company, for the lender. You had Mr. Anand Shah indicating that the credit cost scenario for a lot of state-owned banks could improve much further going ahead as recoveries improve, and of course with loan growth going higher, you could see net interest margins as well improving going ahead. So clearly a very important scenario developing, a very bullish scenario developing for Bank of India, and that is the view coming out from Credit Suisse. And this was really one stock that was buzzing quite a lot, higher by about 7% in trade today. On that note, let's quickly take a status check on the market and how we are set up for the closing bell. And if you look at the market at this juncture, it seems like we are going to have a positive sort of a close on the benchmark indices. The Nifty is higher by about 0.3%, the Sensex higher by about 0.3%. Nifty Bank is doing really well. The Nifty Bank index is up about 1.2%, hitting a new record high also during the trade. But it is the IT space that is really the laggard for the market. The Nifty IT index down about sorry about that, down about 0.2% at this juncture. So clearly, overall the trade setup looks like we are going to end on a positive note after that a favorable outcome from the Gujarat elections and positive cues from global markets. On that note, what to watch out for tomorrow? Well, you have to watch out for, of course, the I beg your pardon, the speech coming out of ECB or European Central Bank's President Christine Lagarde later in the evening. That will be an important speech to watch out for in terms of where ECB's own rate hike trajectory is headed for. Apart from that, the US weekly initial jobless claims data will come out later in the evening in the US. So watch out for that. That could of course be a key determinant on how US markets open later in the evening. Apart from that, tomorrow morning, early tomorrow morning, our time, you will have you have China's November CPI inflation data also coming out. So these three events will definitely be quite key for investors and a setup for trade as far as tomorrow is concerned. So on that note, it's a wrap on this edition of Markets with Santo and CJ. Keep posting your comments, your views, your stock queries on the comment section below, and we will try to take them up later on the show. Also keep following us on the social media links that you can see at the bottom of your screen at this point of time. And for the rest of your financial news, stay tuned to moneycontrol.com and download the Moneycontrol app. We'll catch you again live tomorrow morning at 9 a.m. Till then, have a great day.